Hello, I'm Alan Kohler, founder of Eureka Report, now part of Intelligent Investor, finance presenter on ABC News and a columnist for the New Daily.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are
The Money Cafe.
So just the latest news is Microsoft has come out with its quarterly and its stock's down 7%.
7%, yes.
What caused that?
Well, there's a division in Microsoft called Azure Cloud.
Yeah, it's the cloud services competitor
business
to Amazon's AWS.
Yes, that's right. And if you, it's sort of become the barometer for AI inside Microsoft, because if you're going to do anything on AI, you do it through Azure Cloud. So the market was looking for 31% growth during the quarter. Microsoft delivered 29% growth, which was below the sort of 30% watermark, and the stock's off 7%. So, I mean, a bit of context is important here. We've seen this with Google last week. These companies are investing huge amounts in AI, but investors are starting to say, well, hang on, where's the returns? This is a tiny mess. Like, will anyone remember this in 5 years? Probably not.
I mean, but expecting 30% quarterly growth is absurd.
Yeah.
No one's going to, you can't, nothing, no matter whether AI or not, can't do 30% quarterly growth. That's crazy.
Satya Nadella, the chief executive of Microsoft, has said that their Azure AI client base has increased 60% over the last year. So, I mean, the one thing I'm sort of thinking about, Alan, is this the AI monster sort of biting Microsoft in the bum a bit? I mean, they've made a big song and dance, quite rightly, about how big a revolution this is. Investors have jumped in, boots and all, and now investors are saying, hang on, we got to wait, what do we have to wait 10 years for the payoff, 5 years for the payoff? We want payoff now. So, I mean, is the quarterly reporting cycle in America stupid? Yes.
Yeah,
deeply stupid.
So,
but they're
not going to change it, though.
No, and this is a fascinating theme that AI hype is just starting to crack a bit.
Yeah.
Very interesting.
The other latest news is Rex has gone into administration.
It has, yes.
I suppose the irony is that they bought planes off Virgin when Virgin went into administration.
Yes.
And now Virgin's going to get them back now that Rex is in administration.
Yes.
I suppose it's a good lesson that Virgin is still flying, having gone into administration.
Yep.
So it doesn't mean that Rex is finished.
No, it doesn't necessarily. Then again, history would say that Ansett, Compass, Bonza all struggled to get out of administration. So we'll see. I mean, I think with Rex, the regional part of their network is supposedly profitable, but they took on...
Even if it's not profitable, it's going to get propped up.
It's going to get propped up, probably.
So what's likely to happen is that their attempt at flying to capital cities will stop.
Yes.
And their regional services will restart.
Yes. No, I think that's exactly right. And I don't think you'll hear too much bleating from Virgin and Qantas about government support for Rex.
Yeah, you had an interesting column about that this morning.
Well, the thing is, if you think about it, Rex brings travellers from regional communities to hub airports where those people get on to Qantas and Virgin and Jetstar planes. So it's not in Qantas doesn't want to go out and service these regional communities because it's really expensive and it's hard to make the economics work. So everyone wants Rex to be sustainable in those regional areas.
Hey, what do you think of the Murdoch family action in Rio? Have you written about that?
I haven't. No. Oh, man. It's like, I know everyone goes straight to the succession analogy.
Just to remind everyone, if you've not caught up with it, Rupert and Lachlan have gone to the probate court in Reno trying to get their irrevocable trust changed so that when Rupert dies, instead of the trust going to one vote each for the four children, Lachlan, James, Elizabeth and Prudence,
yes,
they wanted to revert back to one person having absolute control, because at the moment, while Rupert's alive, Rupert's got full control. When he dies, it goes to one vote each. And they want to change it so that Lachlan's got full control when Rupert dies instead of it being one vote each. And to achieve that, they have to prove that they're trying to do it in good faith.
Yes.
There's going to be a trial. This was all broken by the New York Times last week. They got a leak of a document produced by someone called the probate commissioner in Reno, who said that yes, you can change the irrevocable trust as long as you can show that it's in good faith.
Yeah. High bar.
Well, possibly, yeah.
Yeah. Well, I mean, I think it's a high bar because it was supposed to be invaluable, this trust, right? It was supposed to be never to be changed again. I mean, this thing has been negotiated in the past, but what appears to have changed from my sort of outside reading is that the family split. You know, it's Rupert and Lachlan versus everyone else.
And everyone else, particularly James, doesn't agree with
that's right.
Rupert and Lachlan on matters of climate change and politics in general.
Yeah, and so, I mean, everyone reaches, I know, for the succession analogy very quickly, but like it is sort of what happened in Succession. You know, the patriarch chose one child, and everyone else figured out a way to do the patriarch and the child over. Like it's fabulous.
Yeah, sure is.
I don't know what happens though. I mean,
the thing is that even if because the trial's done in September,
yeah,
so it could get resolved fairly quickly. As you say, it's a high bar, probably easy to determine that it's not in good faith, and off they go.
Yeah,
not going to change. But the thing is that doesn't necessarily mean that, you know, the News Corp's politics suddenly changed, because Rupert could easily live to 100. He's 93. It could be 7 years or more.
Yeah.
So, because it only changes once he dies.
Yeah. And, yeah, we don't...
I mean, he'll probably get married again before he turns 100.
We broadly know, you know, that James and some of the other children don't like the sort of hard right-leaning that parts of News Corp have gone down, but we don't know exactly how much they would want to change that anyway. It's all, you know, it's really about control more than anything at this stage, I would have thought. So
yeah,
but
that's right.
Hey, life would be pretty boring if we didn't have a drama like that to follow.
It's magnificent, really, isn't it? It's great. It is great. I've got inflation later this morning. We're recording this in the Short Straw Cafe fairly early today, about 8 o'clock in the morning.
Yep.
So the quarterly June quarter CPI comes out at 11:30. The last quarter was 3.6% annual inflation. The RBA is forecasting 3.8% for the June quarter. Markets also, you know, consensus from the economists is also 3.8%. My feeling is that if it's 3.8%, as predicted, no rate hike in August.
Yep. I think that's right.
But if it's 4%, probably will be a rate hike in August. If it's 4 no, I think 4% maybe makes it a 50-50 call. Yeah. 4.1% makes it
a yes,
an 80% call. I think.
It's the RBA's in a pickle. They don't want to raise rates. No way. But they probably haven't gone hard enough to dampen inflation. And I think governments are not actively working against them, but definitely working against them. Not intentionally to lift inflation, but the stage 3 tax cuts, the massive infrastructure pipeline, it's none of that has been dulled by the rate hikes we've seen. Again,
I personally think they have done enough.
Yep.
So I don't think they'll hike at all, but I don't think they'll cut either.
No.
So,
yeah, I mean, I think you've said that there's no cuts for another year is your prediction, isn't it?
Yeah.
I mean, I think that, and to me, well, I sort of wrote about this week, trying to predict when the next hike is or when the next hike isn't or when the next cut is. Like, we and I put myself in this basket, get very obsessed with trying to do that, right? It doesn't really matter if you're an investor on a 5 or 10 year time frame. What's the lesson here? Rates aren't going back to the sort of zero or close to zero levels that we've got used to. That's the lesson.
Yeah.
And so things will start to break. Crappily run airlines will go out of business.
Yeah.
Crappily run construction companies will go under. crappily run anything will not be able to rely on the sort of crutch of low rates anymore. We haven't seen those cracks. Yes, we've seen insolvencies rise, but they're coming off a really low base. But that's what I think investors need to look at.
Yeah. No, I think that's true. And as long as we don't get a crappily run bank going broke,
yeah, exactly,
it'll be okay.
And
it's not a big deal.
Yeah, that's very true. And our banks definitely are not crappily run, and they are so capital heavy.
Yeah,
they'll be fine. But this is what's supposed to happen in an economic cycle. Haven't really had one for a long time.
Just before we move to questions, US politics. What's your view about what's been going on?
I don't know whether the outcome of the election will be changed. Like, to me, it still feels like Trump is probably the favourite, but the energy of this election race has completely changed. Like, when Trump was almost assassinated, it looked almost he looked a shoo-in, and he would sweep both the White House and Congress.
It was also the case at that point that Joe Biden was still running, and he was clearly unelectable.
Exactly, yeah.
And so, you're right. I mean, Donald Trump, at that point, Donald Trump was a shoo-in, but now he's not.
Now he's not, yeah. And Kamala Harris has changed the energy of the debate, of the fight, not really by doing anything, just sort of by being herself. Yeah. I mean, she hasn't come out. I don't know if she's got a policy platform yet, other than what Biden's policy platform is, which maybe that's enough. But she hasn't announced anything.
I saw someone call her the most left-wing presidential candidate either forever or for a very long time. But I don't know if that's true. You're right, I haven't seen her policies. I don't know if that's true or not.
She's running almost entirely on personality at the moment, which, hey, that's exactly what Trump's doing. He doesn't have a lot of policies.
No. I think the main problem for Kamala Harris is the immigration, the border, which she's seen to have failed about because she was given that job by Biden and nothing really happened.
Yeah.
And I think the Americans are very concerned about the border, the illegal immigrants coming in, and they want something done about it. So I think she needs to come out with a decent policy on that.
Yeah.
To win.
Yep. But it's fascinating. Like, it's about a week and a half since JD Vance was sort of pitched as, what a genius pick, and now he's like a laughing stock.
Yeah, it's right. It's funny, isn't it?
It's weird. So, yeah. I mean, again, that's probably an overreaction on both ways, but it's just that's what I mean with the energy of the debate changing more than anything else.
Before we get to questions, let's have a quick word from our sponsor.
Whether you're a young professional looking to kickstart your investment journey or a parent wanting to give the gift of a brighter financial future, InvestSMART's Fund Later is the perfect solution. Open a $4,000 portfolio that invests in the best companies in Australia and around the world, and InvestSMART will top it up with $6,000. That's a total of $10,000 working hard for you from day one. Pay the loan back over 20 months and get the benefits of compound returns with no margin calls. Fund Later gives you the nudge you need for forced savings, helping you achieve your financial goals. Learn more at fundlater.com.au. Terms and conditions apply.
Okay, first question from M. Recently chatting to a friend about selling their second home and paying off their existing mortgage and investing the rest in equities. I understand no personal advice, but have Australians done better with property or equities, including dividends, in the past? Also, is this a crazy strategy? And should they potentially keep the investment property rather than investing in the Australian market? Well, I think the things I've seen suggest that residential housing and the share market have basically have produced roughly the same performance over the long term.
Yeah.
But the difference in investing performance in each of them has to do with the gearing, because housing you can borrow 80%.
Yes.
And with shares, you can only borrow 50%, and most people don't do it. So most people buy shares without borrowing.
Yeah.
But they buy investment properties and borrow 80%.
Yeah.
So which makes the return from investment property much greater.
Yeah.
So, and that doesn't show up in the in the return statistics, obviously, because, the statisticians or whoever's measuring this can't actually determine what people are borrowing in order to buy the investment property. But the return from investment property can be greater if you borrow.
Yeah. I mean, this sounds like a bit of an all or nothing play from M's friends. I mean, I just don't know why you wouldn't try and hedge your bets a bit and stay diversified.
Well, that's the other problem with residential property. You've got to buy a property.
Yes.
Which is a big lump.
Yeah, they've already got one, though. They're already in there.
I know, that's right, but they're thinking of selling it. So, look, the chances are if they've got 20% equity in the house, 80% debt, their return over the long term is going to be fine. Going to be better than shares.
Yeah.
That's the fair chance of that.
Yeah. Okay. Josh says, I'm about to receive a payout from my employer as a result of them being acquired. I'm wondering if there's a way to avoid taking an income tax hit on it. Are there any capital gains exemptions, or could it be deposited directly into my super? Bit of a... We're shooting a little bit in the dark here, Alan, because I don't know if Josh is being made redundant as a result of the acquisition, in which case there is a better tax treatment for people who are made redundant.
Yes.
Quite generous. And then he throws in capital gains exemptions. So that makes me wonder if he has shares in the... so his payout is from having some sort of equity, in which case there might be a capital gains discount if he's held the shares for a certain period. But you can't really dodge the tax hit on your good fortune here, Josh. If you are getting equity as part of your company's big win, congrats, and tax is part of it.
Yeah, but also he only pays capital gains tax if he gets a capital gain.
That's right. Yeah, that's what I mean.
No, so I mean, depends if the shares vest. If he's got employer shares and they vest, then fine, he's got the shares, right?
Yep.
But if he sells them.
Well, he's going to sell them because the company's been acquired, so
I see.
He's going to get the payout. Right. So, I mean, Josh, if it's a payout big enough for you to worry about it, go and see an accountant and get some advice. But yes, I think you'll have to take some tax hit.
Yeah. Jimmy from Canberra, thanks for the program. A friend recently sought financial advice regarding capital gain on an investment property. The advice cost $600. The thing that caught my attention was that the advising firm referred their client to the same firm's money investing area, which for further fees could help with strategies for investing the money from selling the investment property. On hearing this, I wondered how independent the advice my friend received had been. Not independent at all,
no,
Jimmy.
Fair question, Jimmy.
No. That's right. These people are just funnels for fees.
Yep.
And their whole aim is to get hold of the money that the person has got and to invest it for them and clip the ticket.
Yes.
That's the whole thing.
So your friend Jimmy should do a bit of reverse clipping of the ticket. If some of the advice was useful to them about how to treat the capital gains, that's great, but you don't have to go and invest alongside these people.
No, you do not.
So you can make it a bit more independent. Cameron says, thinking about your comment about high levels of dividends given out by Australian-listed companies that we all love, I'm wondering if this might be a factor in why so many of our companies are being snapped up by foreign buyers in a shrinking ASX. If Australian companies pay out a larger proportion of their profits and hold smaller amounts of cash, their market caps don't grow as much over time, and the cost to take them over is significantly smaller, while also limiting ASX companies' ability to buy out other companies around the world. We are cheap and easy pickings. Alan, what do you reckon? I'm not so sure about the logic here.
So. No, I think Australians tend to bid up the prices of stocks that pay decent dividends.
Yeah.
So I think that the dividend payers are expensive, actually. I mean, I understand what our man here Cameron is saying.
Yes.
That they're bleeding their companies of reinvested capital because they're paying it out instead of reinvesting it.
Yeah, and arguably that does make the company smaller and possibly weaker over time. Yeah, but I guess the other thing, Alan, is it's your money, right? It's the owners of the company's money. So, do the owners of the company want that company to spend up on acquisitions that may or may not work, or would they like the company to return the profits that belong to the owners in a regular fashion, and in Australia in a very tax-effective fashion? So, yeah, but I don't think...
It's interesting. I mean, Berkshire Hathaway's never paid a dividend.
No.
Just reinvested the capital, and the shares are more than $300,000 now each.
You could get a quarter of a house out of the suburb for that. I sort of get where what Cameron's saying. Do Australian companies, I guess in a way, do Australian companies take enough risks? But maybe there's something to it, but I don't think
maybe
it's
there is, Cameron.
decisive.
Impossible really to be definitive about that.
It's an important point to note. It's not just the shrinking ASX, it's the shrinking every equity market in the world. Every equity market is shrinking. This is not just to do with dividends or one country. It's about private capital and how much easier it is to run a private company than a public one.
Yes.
Because idiots like us love nothing more than to point out when public companies stuff up. We don't know when private ones do.
Look what happened to Microsoft this morning.
Exactly. Rex.
7% down. Rex. I mean, look. Yeah, that's right.
We don't know what, XYZ technologies out in the back blocks are doing because they're not public.
Yeah.
So, yeah.
Brad says, I work as a consultant in the minerals exploration industry and most of my clients are junior explorers listed on the ASX. I occasionally invest in junior explorers, but I'm always careful not to invest in any of my clients' companies. Let's say I have shares in a company and this company becomes my client after I've purchased the shares. To avoid any issues with insider trading, do I have to immediately sell the shares the day they become my client? What an interesting question. Or can I keep them as long as I do not buy or sell while having access to their confidential information? Yeah, look, Brad, I reckon that listen, I'm not a lawyer, so don't take this as legal advice. However, I reckon the clue is in the name insider trading. You have to trade.
Yeah. Yep.
You have to trade for it to be a problem. Yes. And if you don't trade, it's fine.
And you have to trade on something that you could reasonably expect would move the market.
Yeah.
Just
knowing what's going on.
I think Brad's probably being overly cautious.
I think so too.
He's allowed to invest in junior explorers that are his clients. He's just not allowed to trade around when he's in receipt of information that he thinks could move the market.
Yeah.
Now, Brad's taken quite a principled stance, and good on him. But you're not prevented from investing in those companies, Brad.
No.
So you're well and truly on the right side.
If he's a consultant to a company and he finds out that company is a really good, well-run company,
yes,
and it's got good prospects,
yes,
there's nothing stopping him buying the shares in that company.
No, not
just because he's found out it's a good company.
Yeah,
that's fine.
Yeah,
I agree.
Dane says, last week you spoke about the ASX accumulation index. Just wondering if there is an ETF that tracks this index or other ways to get involved in it. Yes. Yeah, there are several ETFs that track the ASX 200 accumulation index. Just whack it in Google. I did this morning, and I think there's an iShares option and a BetaShares option and lots of options.
Yeah.
So, easy one.
Chris says, read an article the other day about beer prices on the increase due to the increase in the federal beer tax, which is indexed to CPI every 6 months. Pubs have already had to increase the price of a beer this year by $1 to $2 a pint, with another hike on the way, hurting the small independent brewers and the pubs that prefer to sell beer instead of supporting gambling addictions. Question is, does this increase in beer tax affect our inflation data? And if it does, what other cheeky CPI-indexed federal taxes are there that the government could scale back and reduce inflation? The answer is yes, it does increase inflation.
Yes.
And one that springs to mind is petrol excise.
Yep.
And sometimes when they do reduce petrol excise or cancel it for a while, it cuts inflation. That's true.
Yeah. Some of these things are supposed to be taken into account in the seasonal adjustments, though, right? Smoothed out a bit.
Yeah.
Here's a question.
No, but it's that only is adjusted if it's seasonal.
Yeah.
An actual sort of cut in an excise tax is just that.
Yeah. Been to a pub lately?
I can't say I have.
Yeah. I have.
Hang on. No, I did. Yeah, I did.
There's a bigger point that sort of Chris makes here. It's hard yards for pubs at the moment. It's somewhere between $15 and $20 for a pint of beer in most pubs. Like, I don't know if when you were young, Alan, and when I was young, and probably when most people were young, going to the pub was something that 18 or 19-year-olds or 21 or 22-year-olds did. It's really hard for a 22-year-old who might be trying to save for a house or, in their early career, working part-time. How do you afford $20 pints?
Well, especially when you're having 10 of them. You can't possibly. I mean, that's hard.
I mean, it's just one of those. And a lot of pubs I go into are pretty half full. They are really doing it tough. But I don't know what the answer is. But anyway,
we've got a few questions about ethical funds.
Yes,
ethical
we
super
do.
Funds.
We've got questions from Anya, Damien, and Gareth. I might try and sum a few up.
Go on,
Alan. Anya's looking for a ethical super fund that offers good returns and doesn't cost an arm and a leg. Many of the bigger industry super funds like Australian Super and Aware Super offer an ethical option. However, when you dive into their holdings, many include top 10 holdings in the big four banks who loan to fossil fuel producing companies. Damien says, again, he's similar. He's looking at investing in passive green ETFs. Is there a better option for doing that and supporting companies that actually provide capital to companies that need to transition? And then Gareth says, how can Australian Super square saying that their socially aware fund doesn't buy shares but does buy bonds or lends to companies it won't buy shares in? So this is a sort of interesting set of questions, Alan, which I reckon is basically saying, should an ethical fund completely move away from companies that are struggling with the energy transition, or should they involve themselves in some way, including by providing capital, lending to them, buying their bonds?
No, but do you mean that it's okay to invest in fossil fuels or lend money to fossil fuel companies?
Yes, I do. Yep, I think that's.
How can you possibly say that?
Well, if let's say you've got let's take a company like Woodside. I guess what I'm saying is I can make the case. You've got a company called Woodside, big LNG gas oil producer. Eventually, it's got a climate plan. Investors don't like it, but it needs to get capital down the track to move to producing green hydrogen. I'm using a hypothetical here. Should an ethical fund provide some of that capital to help them make their transition, or should they walk away and then Woodside is starved of capital and says, well, stuff that, nobody wants to help us, we're just going to spew as much fossil fuels as we can for the next 100 years?
Okay, then. So I reckon it's okay for them to provide capital for the specific hydrogen project, but not just to give capital to companies simply because they reckon that they say that we're going to do a hydrogen project down the track.
Yeah.
So, yeah, I mean...
I can see both sides, but I mean... that's how the banks are approaching it.
I think if you've got an ethical fund, that means you're not in fossil fuels.
At all?
At all.
Okay.
Otherwise...
What about banks who might lend to fossil fuel companies to keep them going for the next 10 years so they can make the transition over the next 30?
Well, that's fine. I mean, but the thing is, it's got to be true to label, right? I mean, I'm not saying that lending to a fossil fuel company to keep them going because the lights need to be kept on is bad.
Yeah.
I'm just saying it's not an ethical fund.
Yeah. Yeah.
That's all. I mean, you got to be true to label. That's all.
Yep. Yep.
I would say. I mean, and so fair enough. I mean, so you need to look behind it. The only way to be really sure about what you're doing is ethical is to do it yourself.
Yes, I agree. Yeah. ASIC has done some stuff around greenwashing, but as with everything with ASIC, they're limited in what they can do. So yeah, our three correspondents here are trying to do the work.
Yeah, well,
that's what you have to do.
That's what you have to do. You can't just assume that if the label says ethical, it's fine.
Yeah.
You have to have a look at what they're actually investing in.
And you need to have in your own mind sorted through some of these debates that we've just had.
Yeah, and what's in your mind is ethical.
Yeah.
I mean, because you're right. I mean, some people might think, oh, well, I reckon if Woodside says it's going to build a hydrogen industry, then that's okay.
Yeah. Yeah.
But I personally don't think it is because, you'd want to see it. And anyway, I wouldn't want my money going into gas at all.
Yeah.
If I'm an ethical investor. So.
Yep. Yeah, fair enough.
Okay, time for two or three more questions.
Let's do Stevens, Alan.
Noting your recent comments that Australian politicians don't invest much in stocks, is it because they instead favour investment properties? Should Australian media more heavily scrutinise Australian politicians for their property purchases like US media does for US politicians' share purchases? Oh, yeah? That'll be okay.
Yeah, you can scrutinise them, but what are you going to learn? I mean, the reason that US politicians' share purchases are so heavily scrutinised is for the potential that a US politician finds out about some company and invests in it because they've found out some information in the course of their political work.
Or makes a decision on a committee they're on.
Yeah.
For a company that they are, with a company that they're invested in.
Exactly. So I don't think it's necessarily a bad thing that Australian politicians haven't got too heavily into shares, because it does create the potential for conflicts. I mean, we've seen, wasn't it Malcolm Turnbull who had everything in a blind trust, and even that didn't sort of save him from politics.
Yeah. What about Andrew?
Andrew says, been listening weekly for years. Sorry. Time to contribute a topic. Given the fragility shown last week when one software failure created such havoc, not to mention South Australia without electricity for a weekend and Melbourne without gas a few years back, how can we convince the government to push for redundancy in just about everything? Stop with the central bank digital currency and get rid of cash. Rescind no gas connections for new houses so everyone can have some form of energy just in case. Keep oil refineries in Australia. Oil will be around for plastics, asphalt, avgas for many years. We are deliberately building a more fragile society, and it's very worrisome.
Yeah, sure.
Don't they call that gold plating, Alan?
Yeah, I guess so.
It's an interesting point. The fragility of our system was shown in that CrowdStrike event.
Yeah,
but
true.
The problem is a more fragile system is generally a cheaper one. Building redundancy costs a lot of money, and the money that governments don't have. I mean, think of what would you rather have? Lots of redundancy in energy or aged care funded properly? I mean, I'm just, that's a silly hypothetical, but it is sort of the decisions that governments are making. You can build lots of redundancy in everything, but someone's got to pay for it.
Yeah. I do think that the CrowdStrike, the Microsoft Windows outage was a lesson how vulnerable we are.
Yes.
Half the world's computer seems to have gone down. It was unbelievable.
That's it.
But and Microsoft Azure's cloud services thing, if that goes down, everyone's in the cloud now. So if the cloud fails, we're buggered, really.
Yeah,
that's true. I mean, as for the other things about gas connections and oil refineries and stuff, I mean, either you're worried about climate change or you're not. I mean, my view is that the biggest worry is climate change. Let's fix it.
Yeah.
Let's try to avoid that. That's the one that's going to cause us to be fragile.
Everything's about choices, and choices cost money.
Well, that's it for today. Thanks very much, everyone, for listening to today's episode of Money Cafe. We'll be back next week with me and Stephen Main. Send in your questions to themoneycafe@eurekareport.com.au. Until then, I'm Alan Kohler, founder of Eureka Report.
And I'm James Thomson, senior Chanticleer columnist at the Financial Review.
See you soon.